So the next chapter is ESG considerations in investment analysis. So the LOSA describe global variations in ownership structure and possible effects of these variations on corporate governance policies and practices. So there are two types of ownership. One is concentrated ownership and second one is dispersed ownership. So with concentrated ownership, majority of the ownership is held by a single parent company or a single family, and in dispersed ownership, not even a single person has a control over the corporation or the firms. So the corporate ownerships are generally concentrated where a single or a group of shareholders have control of the corporation. So this is concentrated ownership in which a single or a group of shareholders have the entire control of the company. And second one is the dispersed ownership. So here there are number of shareholders and no one has the control. So basically in dispersed ownership, the companies where the promoters has laid off its all the equities and the majority of the company is held by the public. So there is no one to help for the company. So this type of companies comes under dispersed ownership. So a percentage ownership where a small investor holding less than 50% have the control of the corporations due to dual class shares where some have superior voting rights. So suppose imagine a person having 15% of the entire company, but the person has a entire control of the company, which means the voting power of this person has very much superior to the other shareholders. So this is called as dual class structures, where one voting, when a person gets more voting power from the rest of the others. So this arises conflicts between them. So here we're gonna learn conflict with different ownership structures. So the first structure is dispersed ownership and dispersed voting power. Dispersed ownership means there is not a single person who has majority of the shares, and there is not a single person who controls the corporation. So here nobody has a control of corporation due to dispersed shareholders, where managers maximizes their own wealth. So there is so here no one has a control of the corporation. So the stakeholders like the managers will try to maximize they will give they will give them more incentives. Their salaries will be much more higher as compared to peers. So here managers maximize their own wealth rather than shareholders profit maximization. So this rise to principal agent conflict. Your principal means shareholder. So the shareholders of this company will not be happy as managers benefiting themselves. Second one is the concentrated ownership and concentrated voting power. Concentrated ownership means majority of the shares is held by a single family or a certain type of uh, shareholders, and they have the control over the corporation. So the strong shareholders hold power over minority shareholders and weak managers. So here here manager does not came into picture, like they have no power to give them such high incentives because majority of the power is held by the is held by the family members have the concentrated voting power. So your shareholder has control over the management. So your management cannot do their own. So the downside is principal conflict. So here there will be a conflict between the shareholders only, like the shareholders who has the majority of the stake with the shareholders which are the minorities. So here principal conflict with large shareholders over the power over the overpower the minority. So here majority shareholders overpower the minority. So the third one is dispersed ownership and concentrated voting rights. So dispersed ownership, like there are a numerous amount of shareholders, but a single person or a single family has the total control over of the corporation. So here majority of the shares are not owned by controlling shareholders. They have control due to dual class share structure. Here also principal conflict can arise. Okay. Wherever there is a concentrated voting rights, whenever there is a concentrated voting rights, so there will always be a principal conflict because the minority share will have less voting power as compared to the uh, like the minority like the minority shareholders will have the less voting rights as compared to the majority shareholders. So the next one is the concentrated ownership but dispersed power. So concentrated ownership and dispersed voting power. Suppose like a foreign company wants to invest in a certain country. So what they gonna do? Like they pump huge amount of money to take the to take the control of that company. So some of the countries do voting caps. So no foreign investor can take the control of buying the shares. Suppose if a person wants to buy a company, he will try to get as much as amount of shares. Suppose he has accumulated 50% of the total shares of the company. But due to this voting caps, he will be not entitled as he will not be entitled to as majority voting power. So there's a concentrated ownership, even though he has majority of the shares, but he has less voting rights as compared to the family members or the founders or the promoters. So next part is the categories of influential shareholders. So these like the bank families. So they have a high influence on the company. So a bank and bank is a lender and a shareholder. Suppose a bank has invested 30% into a XYZ company. So the bank will try to influence the company like they should take a loan from their own. They should try to influence the firm to take a big loan from him. So bank will try to influence the company to take a huge chunk of loan even though they don't want the loan, so that the bank will be get benefited. Second one is the families, for example, anonymous. So corporation having family structure, which means in most of the important positions like the CFO, the CPO, or the CEO, the positions will be filled by their own family members. So this gives an image of lack of transparency and accountability. So no one is accounted because they are all the family members. The third one is the state-owned enterprises. When a firm operates in a sector where government finds this is a strategic importance or funds required for the firm is massive, or for the firm like this like that like for the like for making this possible, the firm will require a huge amount of money, but the firm is not in the position. So the government try to save them, like they provide direct benefits to populations where wealth maximization is not important. Like in utility, like or in transmission companies where there is a huge amount of capital required. So the government try to give them a subsidy or try to even to help them where it can be benefited to maximum populations. Fourth one is the institutional investors like mutual funds. And that's mutual funds, pension fund, they generally do not have controlling rights. But but they put enough pressure for shareholder companies. As the various mutual funds controls have 20 to 30% stock of a certain company, even though they don't have much voting power, but they can influence the stock prices. Like if a big mutual fund has invested in a certain company, the company brand has been built, like the company will be taken as a positive stock. Okay? So next one is the group companies. So this is related to mergers and acquisitions, like Samsung has cross-holding shares in vertical and horizontal ownership. So there is cross-holdings of a company like a Samsung is working in, suppose say mobile industries or phone industries. So they have cross-holdings in a company which is making chips. So here we have taken an example of Adani or Infra Group. So they are in need of cement all the time. So they have invested a huge amount of money in ACC, which is a cement company. So it's like a cross holding of Adani into another company. So the minority shareholders of ACC will not get benefit because here the ACC will not try to maximize their own profit, but they will try to sell their product at a cheaper rate to Adani Infra. So the shareholders of ACC will not be happy. Next one is the private equity firms. So this private equity firms, what they do is like they invest in private or public companies. They make them private, enhances their profit operational efficiency, profitability. Like the Elon Musk is doing from with Twitter, as Twitter is all the cash burning company. So what he does is just make the company public, make the company private, and he has made some changes. And I think for the next 5 to 6 years, he's gonna go public again. Seventh one is the foreign investors. The foreign investor do not create accountability and transparency. Suppose foreign investors like a person from USA wants to invest in stocks of a certain country, so he will be looking for the stocks he has uh, like who provides information like they have transparent information. If the stock is cross listed, suppose if the stock is cross listed, suppose one stock is listed in NYSE, and second one is listed in London market, London exchanges. So this gives a good reputation for the stock. Exchanges around the world gives minority shareholders a great protection from fraud accounting. So like fraudulent activities do not take place if stock has been listed into multiple exchanges. Eighth one is the managers and board of directors. When managers and board of directors also have significant shares of the company, they align to shareholders with maximization. So like the management also has the most of the companies providing jobs to the employers. So they always so they won't try to cheat. So they will try to work in the favor of the company. Okay. Next one is ownership structure and corporate governance. So director independence. So everyone wants like every shareholder wants the director of the company to be independent. When board member has no ownership or any relationship with the company, the board is set to be independent. Suppose the BODs or the board members will have a certain relationship or a certain interest with the management. So then the board of directors will not be independent. So independent board is required when there is dispersed ownership where management try to benefit themselves. Like when there is not a concentrated ownership, the manager will try to maximize their own interest rather than shareholders will maximize. It is to the rise to principal agent concept. The principal is the shareholders and agent is the managers who is trying to benefit themselves. Second one is the board structures. There are two types of board structures, one tier and two tier board structure. Most common is one tier. The board made up of both uh, internal directors and external non-executive directors. The two-tier board, management board, is overseen by supervisory board. The supervisory board looks after the management compensation to look whether the firm is working in the benefit of shareholders. So here the management is supervised by the board of directors. Like the BOD will see like who manager like the managers is taking a huge chunk of money like if it is like if it is in comparison with its peers also or not like company is giving $100 salary to their managers but in our company the manager is taking about $50 salary. So the board of directors will monitor them every and they will try to manage their shareholders will. Special voting arrangements, the minority shareholders have special also board nomination and election. So for the purpose of election, board nomination, minority shareholders have uh, to high high number of voting powers. So like all the minority can come together and vote for a single member, like the members who will work for the minorities. Fourth one is the corporate governance, code laws and listing requirements. So many nations adopted, comply or explain. So the countries have made them compulsory to the forms like they have to comply with the best practices of the corporate governance. If the company is not fulfilling this government, they have to explain why they are not fulfilling this corporate governance rules. Fifth one is the stewardship codes. Here the institution investors engages in corporate governance by exercising legal rights and shareholders in maintaining them as compulsory. So like the institutional investors or the mutual funds, they have a huge amount of shareholding in the company. So they will put a pressure on the management to follow the corporate governance structures. LOSB is evaluate the effectiveness of the company's corporate governance policies and practices. Ineffective corporate governance leads to volatile stock prices. Like if the corporate governance of the company is not up to the mark, there will be a huge change in the stock prices on the exchange. So most of the banks will put an additional cost if the firm has to borrow some money. The reputation or the brand will be lower. The profitability because the cost will gonna rise in terms of the borrowing cost. The profitability will be lower. Shareholder activity, of course, if firm is not working in the interest of shareholders. Like the shareholders will topple the management. If the management is not working in the benefit of shareholders. So board policies and practices. Structure of the board when analyzing we should focus on whether BOD are working in the interest of shareholders or not. Like the board of directors are independent or not. CEO duality. When management, that is CEO, is also the head of the board, it may rise that BOD are not working for the shareholders. So suppose efficient company or like a good company should not have a CEO duality. Like the CEO should be a different person and the head of the BOD should be a different person. Board independence. Majority of board of directors should be independent directors. That is, that is no stake in the company. So majority of the board of directors are always independent directors because they don't have any stake in the company. Third one is the board committee. There are various board committees related to compensation, nomination, audit risk. So this every company has a different committee related to compensation, like how much money should be given to the management and nomination who should be nominated for like the top like the for the CEO, like for the CTO position. Second one is the audit, like this audit committee looks into the financial statements, like all the financial statements are found good risk and compliances, like companies not exposed to any risk. So when analyzing board corporation, one should that main committees like financial reporting, management selection, and compensation should be sufficiently independent. So here it is there is saying that all the committee members should be independent. Skills and experience of both. Board members should have industry specific prior experience. So here the who will be the board member should have prior experience of the industry. Like board of a pharma company should have hospital and pharma experiences. Board tenure, a long tenure says 10 years members will have a strong knowledge and a good understanding of businesses. But on the other hand, if a board of member is engaged for a long period of time with a certain company, uh, their independence will be questioned. Like if the board of member is independent or not. Fifth one is the composition of board. It has been seen that smaller diverse board of directors are more efficient than the large board of directors. Other board evaluation considerations. When evaluating board of directors to appease investors and to ensure that firm is operating effectively, two types of evaluation is done. One is self-evaluation and second is the third-party evaluation. Like the self-evaluation will not hold much confidence, but the third-party evaluation will give higher confidence among the shareholders. Executive compensations. Like when a top executive or like CEO or the CTO compensation is analyzed, it should be in line with the corporation valuations. Like we should be creating some or like we should be creating a value which is should be justifiable on the amount of the money he is withdrawing with the company. So metrics such as KPI is used in most of the companies to measure incentive mechanisms. So second one is the clawback policies. So when reclaim past condition if anything done wrong in future or present. Suppose a management manager has done something fraudulent activities in present or future. The whatever the bonuses he has given in the past should be taken away from him. This one is clawback policies. Stay on pay. Stakeholders vote on how much compensation per year. So various stakeholders like the creditors, like the banks who issue loans will they all together come and vote how much company should be given to the top executive management, that is CEOs, CTOs. Second one is the dual class structure where founders have more voting powers to new investors for the same amount of shares. Okay? Like founder has 1:2 voting power. Like for one share, he will be getting two voting rights. But for a normal shareholder, he will be getting one. This LOS is very much important. Like most of the questions will come from this LOS. Okay. How ESG related to risk exposure and investment opportunities may be uh, in, uh, been identified and evaluated. Investment horizon and materiality. Analysts should consider ESG factors while making investments. Okay? Like ESG is a today most of the companies look into ESG factors. Okay? They should determine that impact is material or not. Like it will have an impact on stock price or not. So material means impact on company share price, operations or financial aspect. ESG factors is analysts should focus on which ESG factor is relevant for the industry. Like climate change is not a relevant factor for future. Like the climate change is relevant for the fossil fuel companies. Okay. So there are several methods. First one is the data ESG data provider. So this data providers will have more value because this data is getting from ESG data vendor like MSCI. Like these are the third party companies who provide data. Like like MSCI do their own research and provide the data. Like they give data in the form of rankings. Okay. Like in fixed income, you have like most of the rating companies rate the bonds. Okay. So like MSCI also done this. Like the data of the MSCI will be held in top. Like it will be held in top. Okay. Second one is the industry organization. Suppose there are various industries like automobile, pharma. So all these industries will have their own organizations which provides data every year. Okay. Like the automobile industry have their own of organization of their own. Like they provide the data of how much is the sales growth, how much is the companies make, how much companies making pollutions. All this data is put by the industry organization. So it will be considered the second most of priority. So is like example, IIRC, they provide standardized ESG factors to consider. Example, GRI and SASP. Third one is the proprietary method. So this is the least valued data. So here you do your own research. Like you go onto the internet, you see reports on companies' website, you make your own judgment. Okay. You get data from various filings and reports. You go on news, you talk to certain environmental groups. Like here, you create your own data, which is not to consider for high value data. Second one is the security analysis. Where we want to do the analysis of fixed income, securities versus equity. Valuations of fixed income and equity based on ESG factors are different. So first one is the fixed income analysis. So the analyst usually will focus on ESG factors, downside risk, because there is no upside risk in the fixed income. Like the high chances of like uh, the top is fixed. You cannot get more than 9% for a 9% claim. So the analyst see a potential lawsuit. The analyst see potential lawsuit against the company. So he will adjust the firm's liquidity, credit, cash ratios. This will not affect short-term bonds. Then the long-term bonds because the analyst is seeing that in future the company will get a potential losses. So short-term bonds will be not much affected as compared to the long-term bonds. Second one is the equity analysis. And equity analysts consider both the downside and upside impact of ESG factors. When evaluating firms, an analyst will use lower discount rate for companies following the ESG factors compared to its peers. So as we know, if we use the lower discount rate, the present value will be get much bigger. So if a company following all the rules and regulations, all the ESG factors, so there is no potential risk in the future. So the analyst will overvalue the stock because it follows all the ESG factors. So there are green bonds, fixed income instrument used to fund projects related to environment, like construction of new efficient highways to lower the petrol consumption. Like most of the investors invest in this type of bonds, and the amount collected from this bond is used to elect green projects. The valuation of these bonds is same as the conventional bond. The calculation for all the parts is same, except that if this bond is always trading at a premium price. So this is the greenwashing, where the fund is used for non-renewable projects, so they are advertised for commercial projects. So like this is a misleading thing, like greenwashing. Suppose a finance or suppose a fossil companies like the Saudi Aramco. Okay? They started advertising about the green energy, like the green highways, even though they are even though are the most polluting numbers. So greenwashing is like doing a false advertisement. So next one is the LOSD, evaluate ESG risk exposure and investment opportunities. So ESG factors are included even when valuing the company, like income statements, cash flow statements are adjusted. So in terms of earnings, margins, revenue, say if a company is highly invested in ESG, so loss and short suppose companies doing much more structural changes and try to stay in line with the ESG factors. So in coming periods, they will be dealing with the huge losses, but in future profits will come in long term. So adjustment in balance sheet, say fossil fuel company assets should be adjusted because in future the asset will be of no use because no one is gonna buy fossils. Everything is gonna convert into electricity. ESG integration examples. First one is the environmental factors. A software company has lowered its water usage. In its manufacturing process, suppose a company is require 100 liters in a day for producing soft drinks, but they have invested a huge amount of money in their manufacturing plants. So now their consumption is reduced to 90 liters per day. So this will reduce the cost of COGS and the profit margin is gonna increase over the period. High earnings of price in future. Next one is the social factors. A drug company has a history of product recall, controversy related to product quality, fines, and warnings from the regulators. Like a lot of negative things. So to reflect all this, analysts do some adjustments in COGS. This will have impact on shares and bond price. Okay? So the analyst will assume that this company has a history of dealing with negative news. So they will gonna increase the discount rate and the PV of the share price will be much more low. Third one is the governance factors. Compared to peers, the bank's board of directors have found to be lagging in share percent. Non-independent, if there is a non-independent board of directors, independence will be low. There will be low diversity. There will be low industry experience. Bank has high NPA, non-performing assets compared to peers. To reflect all these points, analysts should increase the spread of the bank's bond and high risk payment for shares. So these are the additional points. If a founding company has 5% the same voting power to the normal investor, here voting powers are concentrated. Okay. Principal conflict can arise because a person having 55% of shares will have a conflict with the minority shareholder. There should be 20 to 50% or so this is the range they have mentioned, like from 20, like minimum 20% of the board members should be independent, like should be independent. Like they should not be a family member or a person. Proprietary methods like the self-testament, like the self-test you do. Like here, you include information from corporate reports, industry organizations, news, and environmental groups. The top priority one was the MSCN, like the third party. Proprietary is the self-test. Quantitative ESG factors like operating margins, cash flow will increase when ESG is implemented. Okay, so these are the quantitative ESG factors. The sector.